Andrew Holland is with us with some perspective on markets. He's Chief Executive Officer, Avendus Alternate Strategies. Andrew, good to have you with us here. Thank you for your time. IT services stocks are down and, all together. Is this ahead of the rate cuts? I don't know why they should be down. Or are you picking up anything else? And what's your view there on that space, Andrew?
So I haven't picked anything up. I saw something yesterday, Prashant, about Accenture saying that they're delaying any kind of promotions in the company for 6 months on the basis that, it's still uncertain, the kind of global outlook. So I don't know if that's something that might be worrying markets, or the IT sector. But that's the only thing I picked up. You would have thought that, ahead of the rate cuts, it would be, a more kind of tailwind for the sector, particularly given it would be good for the overall tech sector in the US. So I could only presume it's something to do with that.
Yeah. A viewer just tweeted to me essentially saying the news item is this: Accenture is going to delay bulk of promotions by 6 months on their outlook. The company said, we are, and I quote, "We are permanently changing our primary promotion date from December to June, which is when we have better visibility of our clients' planning and demand." So this is the news flow which Andrew is referring to. So
yeah,
okay.
I guess that could be it. And maybe some nerves, and I don't know, I'm just guessing over here, that IT has actually done fairly well in the last couple of weeks till we've sort of been in the run-up to the rate cut. And maybe if it is a rate cut and you get back into risk-on mode, maybe the market's mode swings back to the more of the capex plays, manufacturing, the original favorites. And that's really the question. Andrew, hi, morning, great to have you on. That's really the question. In this whole run-up in the last 2-3 weeks, we've seen a bit of sector churn, some money going back in FMCG, definitely going back in IT. Now, if the Fed does start delivering, whether it's 50, 25, and it's a series of rate cuts, then what do you think will the market mood be in terms of what to pick?
So one of the sectors which we talked about last time, when I think the inventories were very high in the auto sector, I said I still think that was a good time to buy. So, that's been a great performing sector. I think what I would do now is move out of that sector. And let's just say, Surabhi, it's going to be 50 basis points. If it's 50 basis points, then, the RBI comes into play for October, for sure. And that would be great for two things. One, it would be great for the banking sector, private banks in particular. But I would say that the NBFCs are more, probably, gain more in that kind of run up. So that's the switch I would make. Also, given that the dollar is hovering against, DXY is around 100. Anything below that's going to be great for metal. So I think the play on a 50 basis point reduction is financials, NBFCs in particular, and metals. So those are the plays I would do depending on what Federal Reserve Powell does tonight.
And that's an interesting point, Andrew. But just to follow up. Typically, the RBI always retains and always projects a very, very independent view, right? And even in the last policy, I remember categorically, the governor was keeping a hawk eye on inflation. It was a bit of a hawkish pause. So would you really expect the RBI to move as early as October? And of course, then, that kind of predicates the call on NBFCs and the lenders.
I think... I mean, you're right. I mean, he's always been cautious and done a great job. So I can't really argue with his interest rate policy over the past few years at all. But I would say that gives him the opportunity. The economy is slowing. You're seeing forecasts being brought down. The deficit is rising because of lower exports and so forth. So I think he can afford, if there's a 50 basis points reduction, he can afford to do a small change, or at least increase liquidity with a much more dovish kind of stance, which will then say that we know December's in play, and we know what's happened with the U.S. markets, right? When we know something's in play, you've seen the markets move a lot higher and a broadening out of the stock selections as well across the U.S. indices. So that's what I would expect to see here as well. So that's why I think even if it's 25 with a very dovish, aggressive stance towards cutting rates, you still have December for the RBI, and therefore those sectors still play out. well in terms of financials and, of course, metals because of the weakening dollar.
Well, you spoke about financials and you've actually handed it to me over a platter, because the one financial stock that everyone's been talking about over the last couple of days is this big listing of Bajaj Housing Finance, currently at 1.5 lakh crore market cap, closer to 6 times 2-year forward book. What's your call on this one?
I can't make individual stock calls, but I've been obviously seeing a lot of research come out, and I think one report today talks about the very small free float of the company, which is helping. But I think the price is again baking in a lot of what I've just talked about. So I think there's other players within the sector which you could actually kind of buy on the basis that they should actually kind of close that gap in terms of valuations. Because if we're all valuing one company so highly, it can't be that everyone else is so bad.
On the financial space itself, another way to play this is the capital markets theme. And this morning, some of these exchanges are doing extremely well, including the likes of MCX, BSE. Not talking about individual stocks, but I mean, how would you, what would your view be on playing the financial space itself through the financial market platforms?
Yeah, I think again on a longer term view, let's just take the kind of market capitalization. If we say that that's going to be equal to GDP in the next 2 to 3 years, so that's what, 4 or 5 trillion. The capital markets are going to continue to grow very, very strongly. So AMCs and exchanges are one of the ways to play this. And of course, if NSE is listed, as the kind of reports I'm seeing looks likely, then I think all of these exchanges will get an extra fillip as well. So I like the exchange, the play on the overall market, followed by AMCs.
Okay. Andrew, on the overall market, what's the sense? We keep talking about these all-time highs and the valuations and whether earnings will keep justifying where we are. What's your sense? I mean, is India still good for more?
See, earnings survey are not justifying the valuations, because I'm seeing only downgrades since the last quarter. Government spending really hasn't kicked in yet, and private capex is still to kind of pick up to the levels I would like to get that multiplier effect where we could go into the second half of the fiscal year saying, okay, earnings will start to increase again. I'm not seeing that. But you have a tidal wave of inflows into the domestic market, and that's hard to fight against. That kind of it's just washing away any kind of fundamental views for the time being, and I think that's going to be the case for a little while longer. So I think liquidity-driven markets always worry me. So it becomes more tactical. It becomes what I just mentioned before, maybe switching from autos to financials and NBFCs. So you're getting those trades, but it's to buy some of these companies on the ratings they have is going to be a long haul to get those returns, in my view. So it's pure liquidity. So you can't fight it. So you have to be with it.
No, absolutely take that point, and that's not an easy market for a stock picker, a fundamental stock picker, to navigate, right? Because it has to be far more strategic and tactical than just purely looking at earnings. In which case, let me ask you the other question. I mean, we're anyway dealing with this tidal domestic liquidity wave. Are you expecting any sort of a mini tide or a mini wave of foreign liquidity as well, which so far has been missing? I mean, it's coming in all the block trades in the secondary market sort of dealings. But in terms of just pure buying, cash market buying, are you expecting that to pick up after this rate cut at all?
So, I mean, rate cuts are always good for emerging markets as the dollar falls as well. So yes, we will get flows. The key is really, will the flows continue to be kind of more passive? I know you talked about individual stocks in terms of QIPs or block trades or IPOs. That will continue. But that's not really kind of individual kind of funds coming into India. So I think the allocations are being more passive. I think the key for India remains what happens in China. And I was speaking to one of my broking friends who had just recently had a conference in Hong Kong, and they were saying, the sentiment towards China is so poor and so low that the money's just coming to India. But beyond the normal kind of Nifty or the large cap stocks, it's getting into the 200, 250. So that's the good news in terms of the broadening out of FII flows. But much will depend on China. If China can turn around its economy and get the stock market going again, then I think you would see more flows towards China. That said, we've still got the presidential elections in the US, and obviously if former President Trump was to get in, then tariffs would be a very big play, and that would hurt China, along with the rest of the world as well.
Let's see. I mean, I guess economic policy is going to be very interesting in the US to watch, because if it is not Trump and if it is Ms. Harris, then there's a lot of chatter about higher domestic taxes, right? Corporate taxes. So let's see how corporate America and investors deal with that. But thank you very much, Andrew, for joining in.
My pleasure.
It's been a pleasure to have you on. So.